Hello, everybody. Vince Corleo,
Cassandra Olson, Tim
Tim
Rowan.
Rowan.
Tim Rowan. So before we get started, we just want to make sure that our audio is working. We had that problem last week, so we're just gonna go ahead and Tim, go ahead and give us a little mic check real quick.
Test 1 2 1 2.
Looks like everything's working great. So let's go ahead and get this. Let's get this going. There's our names. Bam.
Welcome back, you guys.
Welcome back. We hope everybody's staying safe as always. We're staying nice and healthy over here.
Yeah, we are.
We did some yoga the other day, Cassandra and I. Well, Cassandra led the way, but it was good
We
stuff.
did it in the sun, in the heat. It was like I was in my hot yoga class. I was so excited.
I only made.
I was gonna say,
Go ahead.
well, I've heard a lot about hot yoga classes. I haven't dared try one yet, though.
I only made it halfway, Tim. I had to stop. I had to go jump in the pool and be like, that was it. It's a wrap.
It's a different kind of torture. You have to really enjoy it.
And that's saying something from a guy that does one-armed push-ups.
Yes. It's a different kind of workout. I think you trust me. It took a lot for me to be like, I give up.
Well, yeah, guys.
That's
so
fun.
welcome back.
Yeah,
welcome back to our second session.
Yeah, we're stoked. We're ready to go today. So,
yeah.
But before we dive into today's subjects, we just kind of want to briefly review what we went over in that first class, and that was we talked about the 5 most recent recessions that we've been through in our history, and then also we dispelled the myth of I'm waiting for the market to crash. And so if you didn't catch our first video, make sure you watch it. It's on the event page in the discussion tab, or you can go onto any of our pages, and it's one of the most recent videos. So make sure you go check that out.
Right. And so,
Yeah, and I will tell you,
go ahead.
Vince and Cass, sorry to jump in there, but and I know it's last week's, which was a lot of fun doing that with you guys. But I got to tell you, I'm on a lot of conference calls almost daily,
Yeah.
and all the economists and market guys that are forecasting off into the future, they're saying that the home buying market is about to be one of the best opportunities it's been in quite some time, which is completely different than where we were leading after, up to and after 2008. So make sure you go check out that first session. I think it'll kind of lay it out for everybody.
We love to hear that.
And what a better time, right?
And that's why we're here. I mean, we're here to talk about why it's a good time to buy, regardless of everything else that undoubtedly is happening.
Mm-hmm.
That's not great, because there are some things that are happening that aren't great. But one of those things is not the home buying market. So that's why we're here.
Well, Cass, you heard me say it earlier that prior to COVID, there was a need for housing and homes. During COVID, that hasn't changed. There's still a need for housing and homes. And as we move through COVID, and we will, remember, that's my crystal ball talking to me there, that we're going to get through, right? That we're still going to have a demand for housing. And so, yeah, great time.
Awesome. So,
Cool.
You know what? Let's get started. And we're going to pull up our first slide. And so we want to talk about that last session. We ended briefly covering the advantages of owning versus renting. So today we'd like to discuss this in further detail, along with the subtopics of affordability, pre-approval, interest rates, and down payment. The big myth of I need a big down payment.
We're going to dispel that for you today.
So yeah, these are our
Not gonna
topics.
define
What do you want to add, Tim? What do you think we should add to that?
Well, you said some of this. Obviously, we're going to kind of look at some numbers. We want to dive into this a little deeper, the rent versus buy topic, right? We're going to review briefly some products that are out there available for home buyers.
Mm-hmm.
We won't be able to go through it in great detail. The objective isn't to make everybody an underwriter by the end of this, right? But really just kind of lay some basic things out. We want to talk some of the cost effect of home ownership and kind of touch on the loan process a little bit, and maybe discuss some home buying tips and that type of thing. So yeah, it should be fun.
Yeah, I think that this is going to be a great foundation for what's to come later on in the transaction. So, because this is kind of like the scary part that I think that we talked about earlier. So let's go ahead and dive in. You think we're ready?
I think we're ready. Let's do it.
So Tim, we want to touch on what a forced savings means when it comes to the mortgage payment. And here, let me go ahead and switch the slides real quick, actually. Hold on. Sorry about that. Boom. So we want to talk about a forced savings when it comes to a mortgage and the advantages of when it comes to a home. So Tim, My question is for you is I want you to kind of explain and go over the amount of money that we're actually paying in rent and people at home that are renting versus the amount of forced savings they could have towards their home. Um,
For a mortgage.
Yeah,
Okay, and
for
so
the
just so
mortgage.
that I'm clear, just so that I'm clear, do you have that report that I generated up on the screen right now? That screen with the highlighted yellow, or are you on the slide prior to that, the rent or buy?
We're in renting or buying.
So we'll lead
Okay,
into that.
so-
Let's
Yep.
talk about this, and
Yep.
we'll lead into the forced savings because that
Yeah,
is the
so-
inevitable transition.
Yeah, perfect. I just want to make sure. And so now I'm seeing it. I think it'll be coming up on my screen here shortly. The internet delay, right?
Yeah.
So, when we compare buying to renting, there's just some things that we need to be aware of, right? So obviously there's some tax benefits. Renting, there is no tax benefits. And none of us on this call are CPA. So, you have to really dive into that aspect of it with a CPA. But still, I guarantee you there's more benefit in ownership than there is renting. And greater stability. And what we mean by that is rent can increase. And in fact, remember in session 1, we talked about one of the constants during past recessions was rents increased. Here's the good news. If you're in a 30-year mortgage, as an example, what I can promise you is your payment won't increase, right? If you're in a fixed mortgage product, unless, of course, I think Cass said it last week, unless you refinance to lower your payment, so obviously real estate can be a great investment. Here's something that I like to ask folks, and I'll even ask you, Vincent, Cass. So have you ever talked to anybody that doesn't tell you, man, I sure wish I had my first home? And the reason they say that is because, to give you an example, my dad bought his first home in San Jose in 1976 for, I want to say, $74,000. Today, 40 years later, it would sell for 1.5. In fact, you wouldn't even get a stick in the dirt and it'd already be right.
Right.
So, so when you think about a great investment from that standpoint, real estate has always proven to be really good, depending on where you're at in the market. And that, of course, it results to the equity you can build. And one of the things we're going to look at here in just a few minutes is you're not building any equity or investment aspect of renting, right? That just is not even part of the equation.
Throwing it
So
away, right? Isn't that what you said?
Yeah,
Just throwing
it's
it
gone,
away.
right? And pride in ownership. It's kind of interesting, when someone gets their first job, they have a ton of pride. When someone gets their first home, they have a ton of pride. This is my home. You know what I mean? This is where me and my buddies are going to hang out. This is where I'm going to sleep when I get in trouble. This is where,
This is the couch I'm going to sleep on when my wife sends me to it.
that's right. And I have to mow the yard today. And, there's some things that come with that, but a lot of it leads to pride. And of course, any first home may lead to driving the opportunity to buy additional homes, bigger homes, whatever the case is, right? That's how you get started,
And I think,
whereas if you're renting, you could be evicted. And I don't mean because you've not made your payments. I'm saying because now all of a sudden the owner of that home has said, I'm going to sell it.
right.
You're at the mercy
right.
of that landlord, right? So
Well, yeah, the landlord is an investor. So they have that property for investment capital.
Right.
Whenever they decide they want to cash out their investment capital, you're done. You have to move. And
Right.
and a house that you love, that you lived in for X amount of years is gone. It's not yours anymore. And I think that's so powerful because in our renters culture that we live in, so many times do I hear my friends say, I have to move because they're selling the house. I have to go find new housing. And maybe they have a dog. And renting is not very easy with a dog or a cat or any animal. And you might have a pig or a turtle or whatever suits your fancy.
I have a chicken.
But, like to be able to say that nobody can just force you out of the place where you live, I just think that's something really powerful to be said.
And I really like the last bullet point on the buying side. The first home may lead into a better one. We're actually going to touch on that later as well. Using the house that you're currently in to actually get into maybe another one, or using the money that you have in your equity.
Yeah, some people may find that getting their first home is a challenge because it's your first one. You have to do all of it is brand new. The whole process is brand new. Turning in the documents, talking to us, the realtors, the lenders, it's all new. But it's building up to something more. And so I think something we want to talk about today is buying a home isn't just a bill. It's an investment. And so we'll
Right.
get there. But let's head into the next slide because I think this is a perfect time to do that.
Great. And this is where your chart is here, Tim.
Yeah, no, I got it up. Thank you.
Yeah,
And what we're going to do here is just compare a little bit, really, rents versus buying, and kind of the difference. And then we're going to lead into sort of, you used the term, Vince, forced savings. And so we
Correct.
really want to evidence. I think everyone's going to be a little blown away with some of the numbers.
I know.
So
I
what
was
I-
blown away when you first mentioned it to us. Honestly, looking at the graph, and you've pulled this graph up multiple times during our meetings. And once it starts to really click in your mind, I think that it's kind of a no-brainer almost, you know? So,
Well, the numbers speak for themselves. And
Mhm.
so let's let them talk.
That's right. Yeah. Okay, numbers go. No, I'm just kidding. So what I did, and I just, and by the way, I think I'm fairly conservative on these numbers. I'll just say that real quick, meaning I think they could be much more in a home buyer's favor in this market. But I've said that rent is $1,700 and it's $40 a month in renter's insurance. Okay. I think, by the way, renting a home in Folsom, I'm probably on the low end if I pick
very
on Folsom.
low end.
yeah.
Yeah, I mean, we may be talking more like apartment rents, right?
Right.
Anywhere between that and an 1,800 realm. So what I want to do is compare that to a $400,000 purchase price. And so in the middle column, I'm showing, well, if I bought a house at $400,000 and I used an FHA loan, very common for first-time home buyers to use that loan, and the interest rate's 3%, my down payment's 3.5%. You can see the down payment's like $14,000. That's 3.5%, and we'll dive into that a little bit. But here's what's interesting. The mortgage payment, including the taxes and insurance and mortgage insurance, the inclusive mortgage payment is $2,147 a month. Well, that seems, oh my gosh, that's so much higher than my $1,740 a month. Well,
Right.
is it though? Because if we want to compare to rent, the one thing you're not paying in rent is principal reduction. So if we really want to compare apples to apples, then we have to take our new mortgage and strip the principal out of it. Now, if we take the principal out of that, you can see that the payment's really effectively $1,473 a month. Okay. Now, let's all agree as we move forward that the payment is really $2,140, but we're trying to demonstrate something here, right? So, Vince, your point was, you said earlier in this call, forced savings. So that $673 a month is principal reduction. That, by the way, isn't going to change unless, of course, you refinance out of that mortgage. That is going to be applied every month. Does that make sense the way I'm?
I think so.
And I think we can put it in layman's terms. Let's talk about it this way. You're putting that $600, technically, you get to use that later. Right? So when we're talking about a home being an investment, for instance, when you pay your electricity bill, you pay PG&E or you pay SMUD, you never see that money again. That goes to the electric company. The same thing with rent. Your landlord gets the money, you never see it again, you have no access to it. What you're saying is this forced savings, this principal reduction, you get to use this money later. And can you explain that a little bit?
Yeah, sure. So it's now going to end up being in the form of equity, right? And we will talk about it a little bit later in the presentation at the topic of equity. That's not liquid, touchy-feely cash, right? You don't get to go down to the bank and say, hey, I happen to have deposited $670 a month on my mortgage. I'd like to pull out $400 today. No, it doesn't work quite like that. But let's assume the market doesn't change a bit. The house value doesn't go up at all. Every month, you're still applying principal. You're still having equity as a result of the principal. By the way, what's interesting about this current market, not only now, but where we really are forecasting for the next 12 months or so, is interest rates are so low that the amount of principal you're applying is much higher.
Right. So you're
Does that
actually, so your principal is actually, you're putting more towards it every month because of the, you're not paying off as much interest. Makes sense.
Absolutely.
And then, I mean, even when you look at the rent, I mean, your money literally isn't going towards anything. And unless you're actually saving that money yourself, I mean, how many people can save that $600 a month?
Right.
You know?
I haven't been able to. I'm just throwing it out there, as you know.
Right.
So if you want to really look at how these numbers work, really from this forced savings account type of mindset that you brought up, if you want, jump to the next slide.
Yeah, I was going to say, let's
Ben.
go to the next slide. Yep, here we are.
This is an astonishing
Yeah,
slide.
this is the one that really, when Cassandra and I saw it, was just like, that's. I think we're visual learners. I don't know, a lot of us want to see it, and this is it. So go ahead and explain it, Tim.
Well, okay. So in the bottom of that red bar, you'll see. Well, it might be hard for everyone to see, but it says rent. And what this is the exact same report as what we just looked at before. So this is $1,740 a month in rent in the next 5 years. 5 years, you will have spent $106,000 plus in rent.
It's a lot of money. Yeah.
Gone.
It's just right. Well, if we stay focused on that FHA purchase column, again, it's the exact same numbers resulting from the number we looked at before. That's $43,500 and some change in principal reduction. That's the forced savings that you two brought up earlier in this call.
And that's
the number right there.
And Tim, that's not even including the fact that your house could appreciate over time as well.
Like it is
correct?
possible, sure.
So this is just your equity you put into your house over these 5 years. So this is just baseline. And we talked about this earlier. If the market didn't change at all, this is where all the money this is where all your mortgage would be going towards, right?
Right.
That's correct. Yeah. No, that's right. And it's applied towards principal every month, which is really, again, using your words, forced savings, right?
And so
not
Tim,
a savings account. What's that, Cass?
Talk about why and how homeowners can reuse this money. What can they do with this equity now? Say this is their first home, and now they have $43,000 in 5 years worth of equity. Now they want to move to their second home. What's their options?
There's numerous opportunities here. In fact, this is very much the market we're in right now today. So this isn't just focused, just to be clear, this isn't just the impact for a first-time home buyer. This is the impact for any homeowner, right? Mm-hmm. Every time they make a payment, they're paying down principal. And so there's a couple of opportunities that exist when you have a homeowner. So one of the things that we're dealing with right now is a homeowner that, let's just use these numbers, has $43,000 in equity. Right. And over the last 5 years, they've got $20,000 worth of debt that's costing them $800 a month. Now, they don't want to move. They love the house that they're in. That equity has put them in a position to take advantage of lower rates. How crazy is that? Pay off that debt. The savings is unbelievable. We're doing transactions right now that we're saving people $800 to $1,500 a month as a result of doing debt consolidation.
Wow.
Using the money
I'll give you a real number.
Have.
Yes, using the equity in the home that they already have. And I'll give you a real number. One of our top producers at Stanford Mortgage, Sheldon Cooney, I don't mind saying his name. He's the best of the best as far as I'm concerned. And last month, in the month of April, his savings that his clients realized collectively over $11,000 a month in monthly savings as a result of doing debt consolidations with refis and that type of stuff. It's a phenomenal number, right? So there's one tool. But to your point, Cass, let's say you're in your house 5 years. You've now, the value hasn't changed any, but you have $43,000 in paid down principal, right? Equity. And now you go, you know what? We've just had 2 more children, or maybe we had triplets or something, and now we need a bigger house, right? Well, no problem. Depending on where the market is, right? Obviously, there's better times to buy and sell, and you guys know more about that on your end than I do. But if you're in a position where you can now sell the home, take your equity, remember, you started off with $14,000 down payment. Now you can buy up, and you have $40,000 to take towards your next purchase. You see?
Mm-hmm. So there's I was just going to say, now you're coming in with a better interest rate because you're able to put more down. Correct? Like in the last slide.
Well, possibly. I mean, I of course don't have a crystal ball that tells me where interest rates are going to be 5 years from now. And there's all kinds of strategies that can go beyond that. But there's a whole bunch of difference in buying power in certain markets, depending on how much money you're putting down. Mm-hmm. So it just helps and puts you in the driver's seat when it comes to moving up, or for some people moving down, right? Some people's lifestyles change and they want less house, not more house,
And in that case, Tim, when they were getting less house, they actually make this money in liquid cash. Is that correct?
That's correct.
So I think that's something to be said, right? I mean, over time, this is liquid cash.
Yeah. Mm-hmm.
Yeah. So just to be clear, so when someone goes to sell a home, if you sell a home for 500, you paid 300 for it, but now you only owe 250 because you made $40,000 in principal reduction. Well, that difference between 500 and what you owe is all yours.
Yep.
Of course, you got to pay the realtors. You can't forget.
Yeah. Ding, 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 ding. Tim,
We're not cheap, but we're worth it.
we're gonna have to drop off a nice gift basket to Mr. Rowan over there for that one.
Right on, Tim. Well, thank you for explaining
Cool.
that. I think that was a really powerful slide, and I think it's really powerful for us to talk about because we live in a renter's culture where we think renting is easier, it's less commitment, but what we're not realizing we're wasting our money.
Mm-hmm.
Okay, so that's what we really want to make a point here is that buying a home is an investment. It's not a bill. Your rent is a bill. Your mortgage is an investment. And I think that's so powerful for people in our sphere, and that's part of our education, and that's why we're here. So thank you very, very much.
Yeah, I really liked how he touched on, if your property can appreciate over time.
Mm-hmm.
Renting, you're gonna just keep paying that rent off,
Mm-hmm.
and there's not gonna be anything at the end of it.
And your rent will go up because the property is also appreciating. The landlord recognizes the value in his investment, right? And so over time, that rent is also worth more because the property is worth more, even though, like we said, your mortgage stays the same even when your property appreciates in value or you refinance for less. So, I mean, the numbers talk.
Yeah. So, there they are. The numbers are talking again, aren't they, Cass? They just jumped past. I'm going to do a cartoon of numbers talking. So, Cass, to your point, here's what's interesting. When you're renting a house and let's say I'm the landlord and I own the home, and I happen to want to take advantage of pulling some of my equity out so that I can absolve my debt. And I go and I borrow more money against that home. Well, what if I've raised my cost on that home as the landlord? Where do you think I'm going to recoup that?
From the renters, of course. Yeah.
Surprise!
Right? Boom.
Ta-da!
Right.
Right on. Okay, perfect. So that's great. And I think we just touched on that in such a really great way.
Yeah, we did.
And so let's move on to our next
slide here.
Our next slide. And now would be a great time, I think, to talk about the requirements leading up to qualifying and approval. So let's talk about that, and let's talk about, the difference between qualification and approval and all the things we're going to need to get there.
Yeah, no problem. So I think a chart's going to come up here in a minute. Well, it's probably already up.
It is. So what you need to, what you may need to apply.
Yeah. So obviously, we're going to look at employment history for 2 years. Okay. And so we get the names and addresses of your employers, and really almost all loan programs are going to require at least a 2-year employment history. Dates of employment, that makes basic sense, right? Mm-hmm. Pay stubs for the last 30 days. That we need that on all loans. Your most recent pay stubs for the last 30 days. 2 years W-2s. And of course, you'll see on the list, everyone, that we need tax returns. Quite honestly, in today's lending environment, we do loans with very few tax returns, unless, of course, it's somebody that's self-employed, and then the rules change a little bit. We need to do profit and loss statements, Schedule Cs, a bunch of stuff I won't bore you all with. But for the most part, we need W-2s and most recent pay stubs, and really assets. And in fact, if you want to switch to the next slide for me, Vince.
No problem.
Keep up on there.
Yep.
Because that's where it shows assets, and that way would keep everybody on the same page.
Yep, we're good to go.
The big reason for getting the most recent 2 months worth of bank statements is when somebody applies to do a loan, and let's say their down payment's going to be $20,000, their down payment, closing costs, everything. As lenders, we have to evidence that they have the cash to close. Okay, I don't get to just say, Vince, you have $20,000, it's all good. You don't have to evidence to. Right, we actually have to evidence
and I can't just come up with the $20,000, right, and just put it in my bank account, right?
No.
But I think that's kind of a misconception that some people have is like, I have all this cash, I can afford a house, and well, you have to have it in there,
Yeah, you know what, Vince? I'm actually glad you brought this up, and we didn't run through this topic before, but it is an important one, and that is obviously we have to evidence the cash to close. Mm-hmm. And if we look at a bank statement and we see that the average balance is $500, but the current balance is $2,000, we're going to have to explain where that money came from, right? Now, there are some make it allowable. Like if it's a gift from family members, no problem. That's allowed. We
Right.
can get gift.
Mhm.
Think of, and this is really important for people gathering bank statements and getting ready to go through the process. We have to verify and paper trail everything that are non-income or non-payroll deposits. So as an example, someone will say, well, gosh, I just sold my ski boat last week for $20,000. No problem. I have to see the transfer. I have
Right.
to see the DM paperwork. I have to see a copy of the check. So funds to close and the paper trail of them is very, very important. Now, for anybody out there that might be watching that has a lump sum of cash and it's sitting in their closet and you think you're going to buy 90 days from now, honestly, get it in the bank and let it season, because anything, we need 2 months. I need 60 days, right? So if you put it in the bank today, well, then by the end of July, we can close on a house. You see what I mean? And I don't have to source where it came from.
Oh, really? That's
Right?
actually a really good
Yeah.
point. I didn't know that. Okay.
Yeah.
Mm-hmm.
Yeah. So if I just look at the last 2 months of bank history, and so if as long as it's been in there for a full 60 days, so 2 full months of bank statement cycle.
So Tim, I might have to tell somebody that after this class that I hope is listening right now, because when I talk to them, I'll be like, it's already in the bank.
Yeah. Well, that'd be great if someone gets that little pickup note there.
Yeah, that was great.
Because it does happen where people will say, well, gosh, I just have a bunch of cash. By the way, there's a lot of reasons this is the case, but there's a lot of ways to get cash that would not be, I don't know, that could be questionable methods
Right.
of getting cash. Let's
Mhm.
say it that way.
Right.
Right.
Yes, yes.
I think we
Good
all know
catch.
what you mean.
Good catch, Tim. Good catch.
Well, I do want to say though that these steps or these bullet points of what it takes to apply, they're not totally out of the box stuff. If you've been working, you have W-2s. If you have a bank, you have bank statements. If you have
Right.
this stuff already. Now, what I want to say is, as you as the lender and us as the realtor, when we get clients, we say, hey, let's go talk to the lender so that we know how much money we have to shop for.
Mhm.
That's our biggest part, is like, we don't want to show you homes that you fall in love with that you may not qualify for. And so all of this documentation is the setting up for that. And I think that what we need to realize is this part is what we learn about what you're approved to shop for. And I think that's a big part of this. We're not like checking your statements, figuring out who you are. We're trying to figure out what you qualify for, and that's about it, right?
But I think that's what the client thinks, though. I
Mhm.
think that's the misconception here, is that I don't want to give this person all my personal information so they know all about X,
what
Y,
I
and Z.
do and
Right.
who I am.
And that's not, but you just said it. You said it today. It took a month to finally get someone to give the lender their information, and it's like that's what I think is the hardest part for people, is like giving over all of their statements and
Yeah.
banks. You know.
But then, Tim, you as the lender, one thing we do is we say, okay, let's get your information to our lender. Then you say, okay, maybe you don't apply today, but here's what you can do to apply. And so that's
That's
a
right.
really important part of whoever's watching this right now, especially if you're in our age group.
Mhm.
If you want to buy in 2 or 3 years, get your information to a lender today so they can tell you how you will apply in
Mhm.
that amount of time and what steps you have to take to get there.
Mhm.
Why wait until you're ready to go? Because then you'll just be disappointed.
You have to
It will
wait.
seem overwhelming
Mhm.
that now you have to wait to get approved and wait to qualify. Why not just do it now and see what you need to do to get there?
Well, Cash, you bring up a really, really valid point. And I will tell you that maybe one of the silver linings, if there is any, of what we're going through with COVID is it is actually, whether you two have realized it or not, it is changing each of our industries. And in this regard, you have probably run into this, but it is next to impossible to even get in to view a home without a lender's
Yeah.
pre-qualification.
Mhm.
See, here's what's happened historically in our industry. People are interested in wanting to buy a home, and we get it. So what's the first thing they do? They go online and start looking for homes. They don't really know yet what they
Right.
qualify or
Mhm.
qualify for. And understandably, they get excited. Oh my gosh, look at this house. It's only such and such. Great, let's go see it. Now they reach out to you guys and you say, yeah, let's write it up. And then we find out, well, wait a minute. You still have to do this, this, and this in order to qualify. So everything you guys are saying is spot on, and it really comes down to this one word, and I think I said it in our first session: strategy. What is the strategy going to be to obtain home ownership, right? Which loan program is best? What do we need to qualify for that loan program? And what's the strategy to get that done? That's the real key, you know? And so the more and more we can go down that road, and now in this environment, we're sort of being forced to it, you know, in that. So it's all good, and it's absolutely important to start with a lender. And, you know, I'll share with you guys a great example. A lot of folks buy homes and they get gift funds from their parents or grandparents, right?
Right.
Well, what they'll do, and they don't know, it's not a bad thing. The grandma or grandpa will give them a gift before they even started going down the road of the loan program. Now what we've done is just create a situation where we have to source and season and paper trail all of that versus, oh, grandma and grandpa are going to give you a gift. Great. We get a gift letter, get their ability to gift, and grandma and grandpa wire directly to escrow. Our paper trail is done.
Right. Rather than having the money in there beforehand, then going to the lender and then having to trace it back.
Just little tips and tricks.
No, those are great.
Those are great.
So, hey, I think this is where we want to go ahead and, but we want to go back to the main screen, right?
Yeah.
So we're going to go back to the main screen real quick. So, Tim, in session 1, you know, we kind of touched on the requirements in 2008 to getting a loan. And essentially that was the reason why the market crashed, you know. And we went over the guidelines now to qualify for a loan. Can you kind of just describe like how it's different now, you know?
Sure. You know, and we did last week, I keep saying last week. It was just on Monday.
I know.
Sorry.
That's okay.
Anyway, leading up to 2008, remember we were in a lending environment where, you know, I used the term, if you could fog a mirror, we could get you a loan.
Right.
There was literally, think about this. This is how the loan was labeled. No income, no asset. That means I didn't get a paycheck, I didn't get a W-2, I didn't get tax returns, and I didn't even get bank statements. Okay.
I was going to say, those are all the things that we just went over that you have to have now, right?
Right. And by the way, that's good news. It's good news because it protects homeownership in the fact that people are not allowed to overlend, they're not allowed to overextend themselves, you know, with these guidelines. When someone comes in and gets pre-qualified and pre-approved to do a loan today, and we issue an approval, it's because they're approved.
Right.
You know, we have to deal with this on real numbers. So sometimes the process can seem even maybe a little painful, like, oh my gosh, I can't believe I have to explain that deposit to you. Listen, it's a good thing. It really is a good thing. I don't come into the office every day and go, you know, I want to see how miserable I can make somebody today. You know, some consumers may feel that way.
I'm really going to break his heart today.
Right. I can hardly wait to tell them what they got to do. No, that's not the case at all. Usually, by the way, it's not a big issue, especially if we're dealing with these topics much earlier than later. But from a lending comparison, what led us up to 2008 versus where we've been in the lending industry from 2010 till current, this is good news. It's actually what is going to help us come through this, again, the R word, right? Recession, right? It's what's going to help us because today people have equity position. Interest rates have caused an incredible affordability benefit to home buyers. Now, listen, think about this, not just first-time home buyers. If someone owns a home and they say have been in it the last 5 years and they have 4.5% interest rate, sure, we could drop them down into the low threes. That sounds great, right? But do they have a need to move up? And would it make more sense to use their equity, that $45,000 we looked at earlier, to take this opportunity to move up in the low threes versus stay where they're at and refinance? Now, that's not for everybody, but that's a strategy.
I was going to say that's where the strategy comes in, right?
Right. So what's the best move? You know, where's the greatest opportunity to take advantage of where our market is? And there's lots of opportunities.
See, I just love opening this line of communication because I think people are scared to talk about this and talk about the strategy because they're scared of all the documents we just talked about. And so we're really just like opening this line of communication to say it's not that scary and it's better for your future. And let's talk strategy. How can we help you get there? What works best for you? And I think that's what we want to talk about next. And some of that is the tips. So we're going to pull up the slide for the home buying tips that we might have for those who are looking to buy for their first time.
Cool.
All right, here we go.
So the first is obviously to meet with your mortgage advisor before you begin the search. And that's what we were just talking about, right?
Mhm.
How someone doesn't receive a huge lump sum they have to explain later, or we're not going out and looking at properties they never qualified for. So let's talk about this slide.
Yeah. So again, that first bullet point definitely reinforces everything we were just talking about. And to be clear, it's fun to go look at homes. And you guys, I've attended most of all your office meetings, Zoom meetings now, right?
Yeah.
And we talk about this a lot. So I think it's fine. Go out and look at homes, but let's be very cautious and quickly get them hooked up with a lender so that they can really find out where their buying power is. Ironically enough, they may find that their buying power is actually greater today than it was 2 months ago. In fact, I know they will. Okay. So it's really important to get to the lender.
And Tim, I just want to say real quick too that, I worked with clients in the past where they like to know that their max is 400,000. But that doesn't mean that they want to go to 400,000. They usually like to stay below that. But if they find the dream home that they really want and it's that 390, 395, they might go for it and that's where it comes down to not getting your heart broken because you didn't do the work up front and have that pre-approval letter. You're like, oh, we can afford this until assets and everything kind of comes down to it. Like, actually, we're just below it or we're just, So I think that's super important.
No, it's really important. Again, the strategy, right? What's the strategy and what does it look like if the number's this versus this, And as you guys know, we can actually, once we've met with the client and we've come up with what the strategy is, we can actually make those adjustments on the fly. I get called regularly on a Saturday that says, hey, Tim, I know you said 400, but we're looking at a place at 405. What does that really mean for us? Well, I can recalculate those numbers in minutes, So very important on the lending aspect. These are important things. Keep your credit current, and make payments on time. So the scenario is, as you go into escrow on a home, now we fast forward, we've gotten a contract, an offer written, contract accepted, we're in escrow. Now's not the time to stop making your payments. Okay. Lenders in the credit world, not only do we pull the credit to go through the pre-approval process, but just before they close the loan, they're going to pull the credit again. Now, it's called a soft pull. It actually doesn't pull up scores, but what it does pull up is whether or not that home buyer went out and obtained more debt. By the way, it can be a deal breaker, right?
I heard someone buying somebody a car for his wife on Christmas, no more loan.
Right, because it pops up because it pops up at the 11th hour, right? And by the way, if you buy a car and the debt to income ratio still work, no harm, no foul. But if you buy a car and the payment's $500 a month and now all of a sudden you don't qualify, it's a game changer. Right. In fact, that's when you guys are calling me going, Tim, what the heck? So obviously you don't want to incur new debt, no additional debt. We commonly get the question about appliances, furniture, that type of thing. Hold tight. As best you can on all that stuff. It will come, but you want to get the loan closed first before you get there.
You can buy the new refrigerator right after you close on the house.
Yeah.
That's right. That's exactly right. Yeah. And if it causes a problem, well, Vince will give you an ice chest.
Fresh bags of ice.
Yeah, some coals for your barbecue to cook all your food.
Yeah, and one of the other things that you want to try and stay away from doing is having anyone else run your credit. It's yes, it can have an effect on the credit scores themselves. What they're called credit inquiries. And some of the most drastic ones we've seen is, Vince, to your point, if someone goes and buys a car, here's what happens. You're down at the dealership for an hour. Yeah, right. You're at the dealership for like 5 or 6 hours. Right?
Yeah.
And then you drive away. Yeah, and you drive away in your new car and they say, yep, you're all approved. Here's your loan. Well, and your payment. What they don't tell people is that after you've left with your car, they're going to spend the next week sending your application out to all kinds of different banks to finance your loan. Every single one of them pulls your credit. Okay, so you get inquiry, and that just hammers the credit.
That'll ding you.
It will. It'll get you. So it really, it's once you go into escrow, it's like just maintain everything. Don't have any changes versus how you qualified and were approved for the loan. You know.
Perfect. All right, Tim. Well, now I think we're going to move on to our myth of the day.
Myth of the day.
And it's something we hear super often as realtors, and something especially in our age group we hear. And it's something that we just want to dispel, get off the table, and talk about. And that is, I need a big down payment to afford my home. Can we talk about that? Is that true or is it not true? And if it's not, what the heck is?
I have the next slide up for you too.
Yeah, it's not true. Now, I will tell you, years and years ago, and it's interesting how some of this stuff just got ingrained in our society, right? The magic number used to be you needed 20% down to buy a home. Quite honestly, it hasn't been that for quite some time. Now, lending guidelines initially after 2008 really did tighten up, and the lower down payment programs did somewhat go away, but they also very quickly came back. When I say quickly, over a couple of years, and we're going to look at some loan programs here in a little bit. This slide that you have up actually says, it says 3.5% down. You can actually buy a home with as little as 3% down, and in fact, no down with different loan programs, and we'll get to that in a second. But 3.5% down is the number on an FHA loan, right? So think about this. You have potential home buyers on this $500,000 purchase in this scenario that think I need $100,000 in order to buy a house.
Right.
The true number is $17,500. There's a little bit of difference there,
I would say
right?
that's definitely more doable.
Oh, well, of course, especially if you happen to be getting a gift from your mom and dad. I mean, I'd much rather gift you $17,000 than $100,000.
Or we get a nice gift, a parting gift from Tim Rowan. You know.
I know. Thanks, Tim.
Yeah, thanks, Tim.
Just to be clear, I'm not giving you $17,500 either.
But Tim, $100,000. Like, if I was to ask one of my friends, "What do you think it takes to buy a house?" They would say $100,000, and I'm like, "No, that's not it."
Right.
Yeah,
you know,
no.
and that's so important that we talk about that, because it's possible to put 20% down, and we'll talk about that in a moment. But I think that, you know, to know that the option is there to only put 3.5% down on a house, I mean, that is a huge difference. Huge.
Yeah, by the way, and we've talked about this a little bit offline. I will tell you that, again, this comes back to strategies, and everybody's needs and wants and the strategy that works for them are different, right? It may make perfect sense for somebody with a lot of money in the bank to put $100,000 down. In fact, they might need to put $100,000 down just to make the loan qualify for them, right? Everyone's scenario is different, but it is not a requirement. There's not a requirement that says you have to put 20% down. It comes down to what you qualify for, which loan program you're going to take advantage of. And then I'll take it one step further and say, let's just pretend you're dealing with a home buyer that has $500,000 in the bank. Actually, let's use this as a scenario. Someone's moving up to Folsom from the Bay Area. They've sold their home in the Bay Area for $1.5 million. And they're going to walk with $500,000 cash, and they're going to come up and buy here. So understand that they're going to be buying probably more home at a much lower cost in comparison, right? Mm-hmm. So what if they qualified with $200,000 down and didn't need all $500,000? A lot of people believe that you should take all of your money from the sale of your home and put all of it down towards your new home. And in some cases, that may be required just depending on where you qualify. I like to use the term cash is king, and I like to do what I can to protect people's liquidity, okay? So if you think about taking $500,000 from one transaction, putting it into another, you've taken $500,000 of touchy-feely, spendable, liquid cash, put it down on a home, and it's now become equity. Equity's phenomenal. I don't want to take away from that. It's not liquid. You can't. You don't get to go in your backyard and peel $100,000 off your tree, right?
Right.
So one of the things that we have to look at when we're building strategies is how do we protect somebody's liquidity and still accomplish them qualifying for a loan, having the payment range where their comfort zone is, and still protect their cash position. Let's face it, sometimes things come up in our lives that we didn't expect, that could end up costing money. Maybe it's a medical situation. Maybe all of a sudden a car breaks down and, man, I need a new car. Those are real life situations. So I'm a big fan myself of protecting liquidity. And so you don't need to have 20% down. That is not a hard, fast rule on any of the loan programs,
That's
Great.
wonderful.
Maybe on some of the jumbo stuff, which we'll get to that.
So Tim, we're going to go ahead and go to our next slide here. And this is where we're going to be talking about the cost of waiting. So we as realtors, we hear like in session one, is that people are waiting for the market to crash, right? Meaning that the prices of houses will be lower. Can you explain to our viewers how interest rate actually determines affordability more than the price of the home?
Yeah, no problem. Interest rates are definitely way more powerful than the price in regards to an affordability aspect. So what we're showing here is the first column, the buy now, is a $400,000 house. I wish it said that on the report. I probably should have done, but I know because I did the report. That's a $400,000 house on an FHA loan. Today, the interest rate would be roughly 3%. And you can see the total payments, $24.18 a month, okay? Let's just assume that everybody out there knows that the market's going to crash, and they have a crystal ball that I don't. Right? Mine only tells me we're going to get through COVID. Theirs tells them that no, the housing prices are going to come down. In the middle column, what I did is I said, well, what if the house goes from 400 to 375? Okay, but what if at the same time the interest rate has now gone from 3% to 4.25%? Okay, the house actually costs more at 375. Do you guys see that there?
No, yeah,
Yes,
we
we
see
do.
it. Yeah.
Now, I'm actually, it's funny. I don't expect interest rates in the next 6 months to be 4.25. In fact, none of the forecasters are saying that. However, January, February, 3 months ago, they were that or higher.
I remember
3 months ago.
I was going to say we did a deal in December at 4.25.
Mm-hmm.
Yeah. So what you have to think about is, again, the effect rate is having on buying power and affordability. So let's just assume that someone 3 months ago only qualified for 375. Today, they'd qualify for 400, not because they made more money,
Right.
but because of where rates and affordability are. You guys see that?
Yeah,
that's
no,
so
that's
important.
so powerful. Go ahead.
So important, because it's like, I just want the price to drop. I just want the price. If this was cheaper, but they don't even look at the rate.
Right.
And I think that these numbers are powerful. And if you're watching this right now, please screenshot these numbers, go into your phone and really look at them, because these are powerful numbers. These show that price is not the only determinant, of how much it costs you to get in a home. Rate is a huge part of it.
And Tim said it earlier. Remember, he was talking about if you're at that 400,000 and you're like, or say you're capped out at 400,000, but then you have a $405,000 house. I would imagine that this is where interest rate could play part of maybe getting you into that bigger home.
Absolutely. And I will tell you, even though because rates have come down where they are, we don't need to employ this strategy as much today. However, this last year, for numerous reasons, cost of fire insurance, that type of thing, we employed a strategy that was really powerful in this regard. So here's the example. Someone wants to buy a $500,000 house, but their debt ratios are a little high. And almost all home buyers will tell you, I'm not paying what they're asking for that house. There's not a chance, because they want a deal. Everyone wants a deal. And there's nothing wrong with that. What I want to do is shift everyone's mindset to the deal isn't the price. The deal is where the rate is. See, that's what's having the major effect. So in that scenario, what we'd say is, look, how much do you want to pay that person? Well, I'll pay him $480. That's it. I'm not paying him $1 more. Okay. I would use that number and I'd say, okay, at $480 and your rate is still this, your payment is this. But pay him $500,000, ask for a seller credit towards your closing costs, allowing us to buy your rate down, and your payment is this. By the way, it was commonly over a $200 benefit monthly in payment, and they paid the full price. You see that?
And if we're in a competitive market, which for the most part that we are because of the housing crisis, your maybe 20,000 over is going to look a whole lot better than maybe the people that are coming in right at asking price, or maybe just $5,000 over. You want a strong offer because that's the house that you want. Well, here you go, with the same payment,
right,
which is awesome, super powerful.
You know what it comes down to? It's what's the strategy?
Right.
What is the strategy, right? And by the way, let me say this. If you go out and you put an offer on a home, and then you come meet with me and we say, oh my gosh, if we could get a $10,000 credit, I could buy your rate down to this. it's probably too late.
Mm-hmm.
I don't know of too many real estate transactions where you or Cass would go back to the seller and go, you know what, we need a $10,000 credit. Just kidding. So that's why it's so important up front. And then real quick, I'll just touch on this. We don't forecast this happening in the near future anyway, but in the third column, what I'm reflecting is what if the price and the rate went up? We go from a house costing you $2,400 today to costing you $2,950 if that were to happen. Mm-hmm. Okay, that's and by the way, that's probably the difference between qualifying and not qualifying.
Right. Like,
let's be honest.
And so that's right? When you're saying, I'm waiting for the market to crash. I'm waiting for the market to crash. Well, there's a chance where that won't happen and both go up.
Well, it's so funny, Cass, because and even myself included, for years and years and years, if you ask a homeowner, a potential home buyer, anyone that's helping them with their purchasing transaction, and they'll say to you, I think the houses are going to go down. I say, okay, that's possible. I mean, I don't know for sure, right? But just out of curiosity, what do you think interest rates are going to do? Almost 100% of the time, the buyer will say, well, they're going to go up. I mean, they've got to go up, right? Okay, yeah, let's use that.
Right,
right. So it's funny. People think house prices are going to come down, but they also tend to agree that interest rates are going to come up.
Right.
So, okay, let's look at those numbers.
Right.
Exactly. Let the numbers talk.
Let the numbers talk. That's awesome.
Right.
All right.
Talking numbers, I'll tell you.
I love it. I like talking numbers because they speak for themselves. And I think in our industry, it's so important to let them speak because so many people have opinions about what's going to happen. And I think when we come in and say, like you just said, well, let's run the numbers, then we have something to go off of. But before that, with all these, kind of lucid dreams and ideas, that's not concrete. And so we need to talk about what is concrete. And what is concrete are the numbers. They talk.
And I think a lot of people out there are the numbers kind of people. Numbers talk, and it's not just I feel this way. Yeah. It's here's what's really going on.
Yeah.
So, yep.
Great.
Yeah, and by the way, if you look at this, and we don't have a historical chart, we can certainly do this next week if you want. It's always fun for me to dive into some of these numbers. I'm like you, Cass. I love talking numbers, right? But here's what's interesting. If you were to look at a chart and you were to look at the last 30 years, you'd see rates come from way up here, down, 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 down. And we're way down here, right? So historically speaking, here's what I know. I know where they can go back to. What I also know is today, if the interest rate's 3.5%, it can only go down 3.5%, right? It could go up,
right.
However much, right? So, I mean, it's opportunity, it's affordability. And again, today, I mean, in our market, it's just amazing opportunity in that regard. So
love that.
Great. So now we want to move on. So now we've talked about advantages of buying versus renting, how much you'll need for a down payment, how interest rates determine affordability. Now let's move on to get to the nitty-gritty and discussing the types of different loans that are available. So Tim, take it away. Let's talk about what's on our current slide right now and what all of this means.
You got it. And again, I'll try not to turn everyone into underwriters here, so we'll just briefly cover these. So conventional loans, very, very common. This used to be the loan, by the way, that everyone thought you had to have 20% down. Today, you can do a conventional loan in certain programs with 3% down. The most common is about 5%. Okay. So that you don't need the 20% down. By the way, as a side note, anything less than 20% down on almost all of these programs results in mortgage insurance, and that's okay. Mortgage insurance is not a bad thing, okay? And we'll talk about that as we go into FHA. Then we have high balance loans. This is a little bit more of a challenging market for a lot of reasons, especially right now in this market. The rates are typically higher. In today, they are higher. And jumbo loans the same way. Jumbo loans are not Fannie Mae, Freddie Mac traded loans. This is private investor type money from behind the scenes. The guidelines stricter, down payment requirements heavier. Some of those would, yes, require 20% down, right? Mm-hmm. So kind of go figure, right? If you're going to buy a $2 million house, you might need 20% down,
right.
And you probably have it. I'm just going to throw that out there, right? And then the most common, especially for our first-time home buyers, is FHA. And the reason this is the most common is their guidelines are more lax, certainly allow lower credit scores, 3.5% down. It does have mortgage insurance. It has an upfront mortgage insurance, which most people finance into the loan. But interestingly enough, the interest rates are very, very low on FHA mortgages. I would say at least 0.5% lower than conventional.
That's huge.
Okay. So what's that, Vince?
I was just saying that's huge. When it comes down to, we just talked about interest rate and buying power. So,
right. And so then my all-time favorite, and you guys know this about me, is the VA loan. The VA loan is 100% financing, no mortgage insurance, the lowest rates of any of the products. And you guys have heard me say it time and time again. I love this loan first and foremost because anytime we can do something for our vets, I think we should line up to do it. And I just feel passionately about that. And I will tell you that as of mid-January of this year, 2020, VA came out with a rule that you can do 100% financing up to $1.5 million.
Amazing.
With no more.
Hey, Dad, if you're listening, I know you're a Marine. Let's go. Buy me a house. I'll settle for a $750,000. All
right. Now, by the way, both FHA and VA have to be owner-occupied loans. Okay. Same with USDA. USDA, we don't do a lot of because USDA is a rural, and I have trouble saying that word. So it's a rural loan. And of course, there's less and less of those areas, right? And so with USDA loans, when we're meeting with a client and we're building the strategy, we can actually put the proposed property address in the USDA system, and it will tell us whether or not it comes up and complies. There's some income limits involved in that. And then, of course, the one we get asked about most often is down payment assistance programs. In fact, this is what most people mean when you hear the term, what first-time homebuyer programs do you have? What they're really saying is, I need a down payment assistance loan. Because first-time homebuyers, you could do conventional, you could do FHA, you could do VA, you could do that if you're a repeat homebuyer, right? So first-time homebuyer, what most people mean is, I need assistance with the down payment and closing costs. And so a lot of these programs have somewhat taken a back seat right now in this banking industry that we're in right now. However, I was on a call this week, and we think that within a week or two, they'll be rolling back out some of these down payment assistance programs with some new guidelines and stuff. So more information to come on that. Here's what's interesting about down payment assistance. If I told you that an FHA loan was 3%, like the numbers we worked on before, you could do the FHA with the down payment assistance. There's lots of different branding that they call them, but your rate would probably be closer to 5%. So down payment assistance and that second, and in some cases thirds that pay the 3.5% down payment plus the closing costs, there are some terms that make the money forgivable, but let's be very honest, money is not free. It never has been. So they collect it somewhere, right? So when we meet with a client and we're going down this path of looking at down payment assistance, if during the conversation we find out that buyer has access to a gift, they're much better off versus the down payment assistance.
Otherwise, you're going to be paying a higher rate because they helped you out get into the house.
Absolutely. Yeah, absolutely. And by the way, there are people that is the direction they need to go. And if that's the case, you're still much better off doing that than you are renting. Right? I think we would all, right? So those programs are going to start to come back slowly but surely. And that again is just a quick overview from like a 10,000 foot level, right? Just kind of skimming over some of those loan programs.
Great. Perfect. So, all right. We'll move on from that because I think we did a really great surface level touch on that. So now
we're talking about which loan is right for you.
Oh yeah,
right?
there we go.
Yeah, it's fine.
So
our fixed rate versus our adjustable rate, right? I know we briefly kind of touched on the fact that ARM loans aren't necessarily what we do a lot of, but we still do use them. Can you kind of just explain why the fixed rate is more of a go-to rather than an adjustable rate?
Well, and there's several reasons why. I will back up. And we'll back up a long time where we led into 2008. It was not uncommon to go with an ARM loan, an adjustable rate mortgage, because the rate was considerably lower than a fixed loan. If I said your interest rate was 6% on a conventional loan and it was 3.5% on a loan that was fixed for 5 years and then turned to adjustable, a lot of people wanted that loan at 3.5%. That was also at a time where that's the number we qualified them at. Today, that's not the case. Yeah, in fact, what we see today is ARM rates are really very much in line with 30-year rates. So there's not a huge benefit to taking the additional risk, if you will, right? Now, Vince, you and I have talked offline, and I made the comparison with you. I've said, look, if Vince was buying a house and Vince knew that in 3 years, he knew for sure he was being relocated to a new area. Right. He only planned on owning this home for 3 years. And if you could get enough benefit for being in a 5-year fixed loan, well, then, yeah, it makes sense. That's your strategy, right?
Right.
Now, if you were planning, you didn't know, and you said, well, Tim, I'm not sure if they're going to transfer me or not. I could end up here 7 years. Well, then you'd have to look at the risk versus reward as, do you want to spend 2 years in a mortgage that's susceptible to the adjustable rate index, right? Going up. We don't do a lot of them, mostly for that case. And by the way, you want to talk about fear from what happened in 2008. That's one of them. Very, very few borrowers want ARMs anymore because, to your point, Vince, from last on Monday's meeting we had, you saw a lot of bad things happen, right? It was a different type of ARM. We talked about that earlier in the week. But so anyway, the fixed rates definitely come with the most benefit. In my opinion, everyone's opinion could slightly be different. You're protected if the rates increase. By the way, that's obviously the same with comparing it to rent, right? Your payment's not going to change where it could when you're a tenant, right? It's fully amortized over a number of years, meaning that the amount you're applying to principal and interest remains the same, right?
And this all relates to strategy. I really like how you labeled it, because every person has their own financial obligations that they're going to.
And that's what we looked at on the last side, was there's all those different types of loans. And then you as the lender help the client determine which one is best for them, which one suits their strategy, which one suits their lifestyle, their timeline, and all of that comes into effect when deciding which loan you choose to move forward with. Am I accurate in saying that?
You're accurate, and I will tell you, Cassandra, that our ultimate goal is to hopefully be able to educate our client so that they can make an informed decision.
Not have you kind of like, because you can lay it out to them, right? But it's not your choice. But you don't want to have you want them to be educated enough though to make that decision.
I'll share with you guys, and I've been in the loan business a long time, and I'll share with you guys just a deep internal fear of mine from day one that I was in the business. And here was my fear. My fear was I was going to close a loan for you, Vince, and you were going to move into your new house, and you were going to have a housewarming party, and it was going to be a great big barbecue, and some of your new neighbors were going to be there, and they're going to say, hey, what kind of loan did you get? And you're going to go, well, I got a FHA, and I got a 3% interest rate. And then one of your neighbors is going to say, well, why the heck did you do that? The MI, I think, higher on that than it would be conventional. And I didn't ever, and I still feel this way, I don't ever want one of my clients to not have known what their options were and think, well, Tim never told me that.
Yeah, that's a great point.
And so that's just been an internal fear of mine. Like, that's what's kept me trying to inform people, So strategy.
And I think that starts with not just going with the first choice that sounds good, right? That's where it's like, let's go at home and talk about all of the options before you kind of just jump into something,
Absolutely.
Educate yourself so that you can make an educated and informed decision about what works for you. That's really the key.
Help us educate you. Right? Awesome.
That should be a bumper.
Yeah.
I know, it really should, about real estate, because there's a lot to learn and there's a lot to know, and there's so many fill in the blanks that we're finding, as we're talking to people in our sphere, people in our age group, people above us 10 years, below us 10 years. There's an informational gap. And so that's why we're here. And I feel really great about these sessions. I feel like we're really getting the points across that are going to help people make informed decisions and help them be less scared of this, because it's less scary to save $43,000 than it is to spend $100,000. I don't know.
Yeah.
It is. Yeah.
Yeah. Well, it's okay to spend $100,000. What becomes important is what's your return on that $100,000. And when you're renting a house, no return.
No return. Just a bill. Just a bill. Right on, Tim.
So when you're buying,
I think we're wrapping up here, and we're going to stop on this very last slide. That is the loan process made easy. And I think that this is leading into next week. We're just going to give you guys an overview of this. This is what we're going to be going over next Thursday.
Yeah, so make sure you join us next session, our next session, where we talk about how we as realtors and also Tim manage your wants, needs, and must-haves, and after you're pre-approved, how to watch the market, and how to how we all stay closely connected during the entirety of the transaction, because there's a lot of working parts, as you can see in our little slide here. And that's what we're going to come next time and just kind of explain after you get pre-approved what to expect and how to get there.
Because we are a unit. We all work together to accomplish the same goal for you as our clients.
Yeah, this is our little Candyland game board right here. Like I want to play Chutes and Ladders or something and run around it, right? So, guys, this is always a ton of fun, and I look forward to it. In fact, I got to tell you, I think we're covering so many topics. This is probably going to go on for a little while, the way I'm seeing this. There's so much more we can continue to talk about, and hopefully bring this, bring more value out there. But I will say this, Vince and Cassandra, I will send to you a live link of that very report that we looked at earlier. And then if you guys could put it on the post, I guess, I'm going to count on you.
Yeah, I'll drop it in the discussion like we did the first time, so that way people can access it easily. And if you need to figure out where it's at, just contact one of us. All of our numbers are all over the place.
We'll send you the slide, the PowerPoint slide. Please look over the numbers. The numbers don't lie. Let the numbers talk. Let them lay it out for you and show you that you could be gaining equity, wealth, and money for yourself, the hard-earned money that you go to work for every single day you spend your life doing. So yeah, that's what we're here for, and join us next time, next Thursday, same time.
Yeah, we're ready, and it's going to be Thursday this week. We'll be ready.
Affordability leads to opportunity, right? And both are sitting right in front of us right now today. So
that's right.
And by the way, if you don't come up with a cartoon of a bunch of numbers talking at the top of their
all right.
We'll get our video guy on it.
You guys, it's been a ton of fun. Thanks again.
No
for
problem.
Having me.
Thank you so much for joining us, Tim, and thank you everybody. And once again, we just hope everybody stays safe. And remember, we are better together.
Bye.
Yeah, it's always better when